Most traders see a massive price spike and think they missed the move. Professional traders see that same spike, wait for this consolidation pattern, and ride the second wave for a massive profit. It's called the bull flag, and today I'm showing you exactly how to trade it. Think of a bull flag like someone sprinting. At the start, they take off fast, a strong, obvious burst forward. On the chart, that's the big move up. That's the flagpole. But nobody can run at full speed forever. So after that first push, they slow down a bit. Not because they're done, but just to catch their breath before moving again. On the chart, this is where price stops going straight up and starts moving sideways or gently drifting lower in a tight range. It doesn't fall apart and it doesn't look panicky, it just pauses. A lot of people see this and think the move is over, but most of the time, it isn't. Then comes the second run. Once the short break is done, price pushes higher again and breaks out of that small range. This is the moment professional traders wait for, because it tells them the pause is over and the trend is continuing. And here's something interesting. Very often that second move can travel about the same distance as the first move up. So the initial sprints actually gives you a rough idea of how far the next one might go. That's why the bull flag works so well. It's a strong move, a short rest, and then another push in the same direction. Alright, now that you know what a bull flag looks like in theory, let's switch to the chart and see how this actually plays out in real price action. So let's look at this Bitcoin example. Price runs hard from roughly $25,000 all the way to $70,000. That's a massive move, and that is our flagpole. Now instead of dumping back down and erasing those gains, notice how the price just starts moving sideways. It bounces between $70,000 and $55,000 for a while. This part really matters. Even though it's pulling back, it's only giving back a small fraction of that original move. Compared to how far it ran, this pullback is actually very shallow. That is exactly what you want to see in a healthy bull flag. It shows the buyers are holding their ground. Now let's talk about this trade. The entry is straightforward. You aren't buying inside the flag and guessing. You're waiting for the price to break out and hold above the top of that range. That breakout is your confirmation that the breather is over. For the stop loss, it goes below the flag structure. Because if price falls back into the range or breaks below it, then the setup is no longer valid, and there's no reason to stay in the trade. Finally, for the targets, we go back to the flagpole. A simple rule of thumb is that the first move up shows how much gas is in the tank for the next move. Most traders take the length of that flagpole and project it upward from the breakout. It gives you a realistic profit zone to aim for. As you can see in this example, once that breakout hit, the momentum returned and pushed the price right into that target zone. Before we move on, let me show you how to actually draw the flag. The goal here isn't perfection, it's about capturing the range. I start by connecting the highs of the pullback to create my resistance line, and then I connect the lows to find my supports. But here's the key to making these lines valid. Look for the touches. A trend line is just a theory until the price respects it. Ideally, you want to see price touch each line a few times. Those multiple reactions prove the market is actually seeing that ceiling and floor. You don't need to force the lines to touch every single candlewick perfectly. If the structure looks clean and the price clearly respects the boundaries, that's your flag. If this is making sense so far, hit the like button. It really helps the channel and it lets me know this type of breakdown is useful for you. And if you're new here, subscribe. I post clean structure-based trading content like this every other week. Now let's look at the second example. This time on the S&P 500 to walk through what this setup actually feels like in real time. Price pushes up aggressively from around 2,200 and surges around the 4,800 area. This is where the FOMO kicks in. Most beginners see those massive green candles, feel the momentum, and buy right near the highs because they're terrified of missing out. Then price starts pulling back. It drops from around 4,800 back towards 3,500, and this is where emotions kick in. Beginners starts to panic because they bought late and now they're already in the red. They see a few red candles and think the trend is reversing. But if you zoom out, price isn't collapsing. It's moving in a controlled way, drifting lower inside this range. That pullback looks scary if you bought the top, but structurally this is actually where bull flag is forming. This is usually the points where most people give up. They either sell at a loss out of frustration or they simply stop paying attention. So when price finally breaks out of this range and starts moving higher again, they're no longer in the trade. Now if you were trading this with a plan, the idea would have been simple. You wait for the price to break out and hold above the top of the flag. Your stop goes below the flag structure, and for the target, traders often use the size of the first move as a guide for how far the next one might go. At the end of the day, trading isn't about predicting the future. It's about recognizing patterns and managing your risk. The bull flag is one of the most reliable setups out there, but only if you have the patience to wait for the breakout. If this video helped you understand bull flags more clearly, make sure to like and subscribe. It really helps the channel grow and lets me keep making contents like this. And in the next video, we're flipping this concept around and breaking down the bear flag pattern so you'll know how to spot and trade the same setup in downtrends as well. Thank you, and I'll see you in the next video.